Okay, it looks like the last couple of people are trickling in, so we'll go ahead and get started. Once again, thank you for joining as we cover economic leakages as our webinar topic for the day. This webinar is all about how we account for leakages in an economic impact analysis, which is the type of analysis that the IMPLAN software does the best. My name is Wes Morgan. I am a member of the data development team here at IMPLAN, and today I will be joined by Dr. Jenny Thorvaldsen, who is our fearless leader on the data team, as well as the chief economist of IMPLAN. Here at IMPLAN, we do like to keep our webinars interactive by allowing attendees to post questions to our presenters. So if anything does come to mind, please know that we're happy to consider any questions that you might have. Today's presentation will likely take closer to the 50-minute mark, so we do ask that if you have a question related to today's topic, to please utilize the question box in GoToWebinar. Jenny and I will do our best to monitor the question box throughout the presentation, and we will send replies out individually should we be able to catch and answer them while the other is speaking. If you'd like to ask a question, please just make sure that you have your control panel open by hitting that orange arrow on the upper left portion of the pop-out window. From there, you'll be able to type your question into the box labeled questions as shown in the screenshot right here. At the conclusion of the presentation, we will field whatever questions may be left, or we may restate and re-answer some of the questions that we've answered individually that could benefit the entire group. If we don't get to your specific question, either through the chat feature of GoToWebinar or the Q&A portion there at the end, please don't worry, we will get to follow up with all of your questions via the email that you use to register for this webinar with. Okay, so as for what we're going to go over today, I'm first going to go over the basic ideas behind an IMPLAN analysis and cover multiple rounds of spending that comprise IMPLAN's economic impacts, just to get you all familiar with where leakages might come into play in the context of your studies. That should help define what leakages are. Next, I'll pass the mic over to Jenny, who is going to go over what the two main categories of leakages are and what they mean, and then discuss those leakages and how we source the data that underlies them. Finally, Jenny is also going to walk through an example of where to find this data in IMPLAN. So to begin, economic impacts consist of multiple rounds of spending. Within any IMPLAN impact report, IMPLAN users are able to see their economic impacts broken out by total impacts, direct impacts, indirect impacts, and induced impacts. And the total is just the sum of those latter three. A direct impact is really just the initial change of interest. So this is what you as the IMPLAN user are bringing to the table. Direct impacts could be positive, such as the construction of a new manufacturing facility or the creation of new jobs in your region or something like that. Or direct impacts could be negative. Think about maybe the closure of a power plant or corporate layoffs, just to name a few examples. Or a direct impact could be a mix of both. So economic shifts often stem from wide-ranging changes throughout an economy in which a user might need to look at a net analysis of multiple direct impacts. Regardless, we just want to impress upon you that direct impacts are the shifts in your economy from which you would like to track the ripple effect or economic impacts of. Indirect impacts are those business-to-business transactions that are initiated by input purchases from your directly impacted industry. So when you cause a change to an industry and it buys things from another industry, or maybe it buys less in the case of a negative impact, the records of those B2B transactions comprise our indirect impacts. Finally, we have induced impacts, which are all those impacts that stem from employee spending. That is direct to customer purchases, say an employee of an impacted industry buying their groceries and paying their rent and so on, and so forth. And then also those business-to-business purchases that stem from initial employee spending. Say an employee pays for groceries and then the grocery store uses that money to pay their electricity bill. That business-to-business transaction between the grocery store and the electric company started with employee spending, so the transaction is still going to be categorized as induced. Ultimately, an IMPLAN impact report is a summary of the direct, indirect, and induced impacts caused by all of the rounds of spending that come from a direct impact. So in order to illustrate how all those rounds flow from one another, let's take a look at a quick example. So our example is going to be that Chipotle is planning to open 200 locations in 2024. Just doing some quick calculations, the Q1 2024 revenue for Chipotle was $2.7 billion across 3,437 locations, which works out to roughly $800,000 per location per quarter. Multiplying this by 4 quarters and 285 new locations, we can come up with a direct impact of $895 million in annual revenue to put into the limited service restaurants industry in IMPLAN. From there, we're just going to go through a few rounds of the indirect impact. Right. So to look at our first round of indirect impacts, we first need to look at what the limited service in restaurants industry buys. If we pull up its spending pattern, which is available to see in the IMPLAN software, we can see that this industry buys things like advertising and public relations and related services, electricity, and cheese and meat. Jenny pointed out that cheese really is the first food commodity that this industry purchases, and she made a great joke that it kind of provides some insight into American eating habits, which that was funny. Anyway, the industry buys all of these items all the way down to paperboard containers. There are more purchases that aren't shown on this slide per se, but this is just to give an idea of what the spending pattern might look like. So once purchases are made by our Chipotle locations for paperboard containers, we now have an influx of money going towards the paperboard container manufacturing industry, which is the primary manufacturer of the commodity of paperboard containers. Well, they then also purchase according to their spending pattern. They buy things like paperboard from pulp, paper from pulp, truck transportation, and so on and so forth, down to wood pulp. Once again, there are more commodities purchased by this industry than is shown in this slide, but we wanted to give you an idea of what is purchased. And then, as you might have guessed, the pulp mills industry spending on inputs could be considered in our third round of indirect impacts. They go on to buy the commodities that they need to run their business and produce their main commodity, and the cycles continue on and on. So while those examples only covered indirect spending, I will just say that the induced impacts work in an analogous way. The portion of output that each industry dedicates to employee compensation is distributed out to employees and household spend. And you get multiple rounds of purchasing that's all triggered from household spending. Both indirect and induced spending can be quantified via multipliers, and the IMPLAN tool does display multipliers in terms of indirect and induced effects, as well as multipliers. Essentially, a multiplier is just a single metric that describes the total impact per direct impact. So it is calculated via division. If you'd like more information on how multipliers are calculated, we do also have a YouTube video on that subject available on our YouTube channel. And then we did just also want to briefly mention the power series approximation method, which calculates each round of spending separately. So this works the same way as IMPLAN, has all the same foundational building blocks, but will miss out on a few rounds of spending due to practicality, just because you have to run a huge number of calculations. And that of course takes a little bit more time, especially if we're looking at something like a multi-regional analysis. And then it also runs into precision limits just because of the size of the values that you're dealing with. This is not something that one can do in IMPLAN currently, but is certainly available for further study in literature and in some of the more prominent input-output resources, if for some reason you ever wanted to show each of those rounds separately. So this brings us to the question of the day, which is what prevents the cycles of spending from continuing forever? And the answer to that question, of course, is leakages. Without some money leaking out of these iterative rounds of spending, we would have money being spent endlessly and then just get a multiplier of infinity. Leakages are what cause our dollar value to get successively smaller until becoming zero. And here at IMPLAN, we cut off our rounds of spending once the dollar value in question goes down to 1 penny. In this way, we're able to prevent overestimating economic impacts in the study area in question. We only account for the dollars that truly stay in our local region by making sure that an appropriate amount of money is leaked out of our spending rounds. In the software, all of this is taken care of automatically for you. So it's not really something that you need to think about. All right. So now that we have kind of an idea of what leakages are, what they do, and why they're important for economic impact analysis, I will go ahead and turn it over to Jenny, and who, as I mentioned earlier, is going to go over what the types of leakages are, the data behind them, and where to take a look at them in IMPLAN.
All right. Hi, everyone. Thanks for that introduction, Wes. Wes, can you tell me if you're seeing presentation mode from me?
I am seeing your presenter mode.
Presenter mode.
Yep, so I see your mouse.
There we go. How's that?
There we are, perfect. Perfect.
All right. Thank you so much for that introduction, and thanks everyone for being here. So I'm going to now talk about two main categories of leakages, and then in the following section, we'll break it down into the specific types that fall under each of those main categories and where we get the data for them. All right. Okay, so we first have geographic leakages, which, as you can imagine by the name, have to do with place, and specifically where goods and services are produced versus where they're consumed, and where people work versus live, because that has to do with where people earn their money versus spend their money. So they have to do with place. And then we have what we call circulation leakages, which don't really have to do with place, but have more to do with uncertainty as to whether, when, where, how, and how certain types of money will be spent. So we'll talk about each of these in turn. So geographic leakages consist of imports and commuting. And we'll talk about each in more detail in the last section. But basically, we're going to talk about how these leakages impact single region models and single region analyses and multi-regional analyses. In a single region analysis, geographic leakages mean that all expenditures on imported goods and services completely leave the region. And so this is that dark blue arrow. So in this example, we have in our graphic here, we have North Carolina as our single region. Now, first, I just want to mention that single region can also be made up of many smaller components, meaning you can have a single region model that you have built out of several counties. For example, MSA models are models of several counties that make up a metropolitan statistical area. That's still a single region because you've built them all to be one region. So that would still be considered a single region model. And so all imports of goods and services completely leave the system. Those dollars are a complete leakage. And in this graphic, that would be the dark arrow, blue-green arrow going down out of North Carolina. And so we've got our direct impact happening in North Carolina, and then some spending happens within North Carolina. That's our light blue arrow, but some things are imported from either, and this includes foreign imports and domestic imports. So imports from other states in the country. Those are all leakages here, and they're that dark, represented by that dark blue arrow. Similarly with in-commuter wages. So people who live or work in North Carolina, but live in a different state, their wages are also going to leave the state. We're assuming that they do their spending where they live. And so the one thing that does stay in North Carolina with the worker's income is the payroll taxes, because payroll taxes accrue at the place of employment, regardless of where the employee lives. Okay. One thing I want to point out here as well, that even if an item is purchased locally at like a local retail outlet, doesn't mean that the item was produced locally. And IMPLAN has all that information in here. So what will happen in that case is that the local retailer will get to keep the local retail margin. So their markup on the price that covers the services that the retailer provides, that will stay local, but the producer value, the value of making the good, the value of the good itself that was sold at that retailer, that is still a leakage. So that's all taken care of in IMPLAN. In a multi-region analysis, which we call at IMPLAN MRIO for short, multi-region input-output analysis. In a multi-region analysis, it's a little different. You capture some more of those what would otherwise be leakages when it's trade between those two regions that you're linking. So in this graphic example, we have North Carolina, but we have linked it to a model of South Carolina. So we haven't combined them into one single model that our economist Candy Klaus calls Super Carolina. Here we've kept them separate. We've got North Carolina separate from South Carolina, but we've linked them in a multi-region analysis because we want to see, hey, that direct impact that's happening in North Carolina, we want to see what ripple effects it might have in South Carolina. So we've linked them. And in a case like this, imports and commuter income from non-linked regions still completely leave the region. So these are still our dark blue arrows. We've got one going out of North Carolina, this time it's going out at the top, and then we've got one leaving South Carolina going out the bottom. So these are imports of things from other states in the United States and from other countries, as well as workers who might live, work in either of those two states, but live in some other state. Okay, so those are still total leakages, but we're capturing more things because imports and commuter income from the linked regions do generate impacts in those linked regions. So this will be the light blue arrow going from North Carolina to South Carolina. It's saying, hey, of some of the things that North Carolina imports, some of them come from South Carolina. And some of the people who work in North Carolina live in South Carolina. So they're going to have some indirect and induced impacts in South Carolina. Okay, cool. Well, that goes even further because you'll see that there's a light blue arrow now going up from South Carolina to North Carolina. And that's because some of those indirect and induced impacts that were spurred in South Carolina are also going to have impacts in North Carolina because South Carolina imports some things from North Carolina. And some people who work in South Carolina live in North Carolina and spend their paychecks there. So you're getting these additional feedback effects in the base region. In this case, North Carolina is the base region. So you're capturing more leakages, not only because you're capturing some of the impacts that happen in South Carolina, but also because the impacts in South Carolina have additional impacts in North Carolina that you weren't accounting for in your single region analysis. Okay, we talked about geographic leakages broadly. Now we're going to talk about circulation leakages. These are things like savings, corporate profits, revenue that goes to administrative government, and inventory sales. Now, these are different from geographic leakages because these dollars don't leave the region. They exist both in single region and multi-region analyses, and they're included in impact reports. The reason they're leakages is that they don't generate additional impacts. So that's why we call them leakage. They're still there, we're still accounting for them. We still have a savings number and things like that, and we have a tax impact report, but those taxes don't generate additional rounds of spending, okay? So they're taken out of circulation, in other words, which is why we call them circulation leakages. They're set aside, not respent. Okay, so those are the two categories broadly. Now let's just dive in a little bit deeper into each specific type of leakage. So we'll start with our geographic leakages. We said they were imports and commuting. So let's first talk about foreign imports. For shippable commodities, so think goods, solid things, items, we get those data from the US Census Bureau. We buy them every year from their merchandise trade data. These are annual data. They're current to the IMPLAN data year, and they give us full commodity detail that we need. So this is great. And we control all their values to the annual current value we get from the Bureau of Economic Analysis, National Income and Product Accounts tables, NIPA control total for foreign imports of goods. Okay. Now for the foreign imports of services, for this we use the BEA's benchmark IO tables. Now those of you who aren't familiar with the benchmark IO tables and what that means, Wes and I also did a webinar on the benchmark, which we just did a couple months ago, and you can find that on our website if you'd like to view that for any more details on it. But it comes out every 5 years. And it gives us pretty much full commodity detail that we need on the imports of services. Now we update those values by controlling them also to an annual current BEA NIPA control total for the foreign imports of services. Okay. Okay, what about domestic imports? This is something for which there isn't raw data specifically for the domestic imports of goods and services. This means trade between all the counties in the US. And so we have a gravity model that we use for that. And we also have we have two great resources for this. We have a YouTube video on our gravity model that gives a nice high level summary of it. And also we have a lengthier paper on our support site if you want to read even more detail. So I'm not going to go into it in length here because we have those resources, but really briefly, I'll just say it is based on the physical law of gravity, where two masses, I guess, two things are attracted to each other positively according to how big those two things are, and negatively according to how far apart those two things are. So it's very similar here with trade, where our masses, instead of being the physical mass of these items, it's the demand for each commodity in one place and the supply of that commodity in the other place. And then the distances between them aren't as the crow flies distances, but actual travel cost index by mix of transport mode for each commodity, which we get from Oak Ridge National Laboratories. So it's really the distance of shipping certain goods back and forth. And then we do calibrate it with average miles moved by commodity from the Census Bureau's Commodity Flow Survey. And that survey does have some domestic trade information, but we don't use those data outright because they aren't origin of production in all cases. It's origin of movement, which can be different from the origin of production. So don't need to get into all that detail here. It's in the paper and in our presentation or in our video. But basically we do kind of use it as a calibrator because heavier things tend to move less far. Like think shipping cement. We're probably not going to ship cement as far as we might ship something that's lighter or can go by rail instead of by truck or whatever. So we do use those data in that way to help us kind of as a calibrator for how important distance is for each commodity. And that's how we get our domestic imports. Okay, our other type of geographic leakage was commuting. And I already mentioned payroll taxes accrue at the place of employment, so it is part of the base region's tax impact. But personal income taxes accrue at the place of residence, so they won't be part of the base region tax impacts. They'll be part of any linked regions tax impacts for those commuters. And then the spending of disposable income, which is the after-tax income, is assumed to occur at the place of residence, as I mentioned. And that's just sort of a safe assumption. And then our data sources for commuting are the Census Bureau's Journey to Work data, which gives us gross worker flows between county pairs. And we turn those worker flows into dollar flows. And dollar flows kind of flow in the opposite direction. If the worker comes from South Carolina and works in North Carolina, they then take their money with them from North Carolina to South Carolina. And so we convert those into EC, employee compensation, net of payroll taxes. And then we also use, just as a calibrator, as kind of a control target, the BEA regional economic accounts data on net earnings flows by county. So those data don't show county pairs, but they do show the net earning flows by county. So in or out, how much on net flows in versus out. And so we use those as control targets. Okay, moving away from geographic leakages and going to our circulation leakages, we said that savings was one of them. And most household income groups do not spend all of their disposable income. Now, this depends on the year, depends on the region, and it depends on the household income group. And so it does vary, but you'll see when we hop into some data at the end of the presentation that you'll see that just some of the household income groups have savings. But anyway, we don't collect data on savings rates. We calculate it as a residual between household income and household expenditures. We have great data on household income. We have great data on household spending. And the difference between the two is savings. Let's see. So our data on household income comes from a couple data sources. We use the Bureau of Labor Statistics Census of Employment and Wages data. That gives us data for plenty of industries, more industry detail than we even have in IMPLAN, but it only shows us wage and salary income. So it doesn't show the benefits, the payroll taxes, the fully loaded employee compensation. So for that, we turn to the BEA's regional economics accounts data, and that gives all forms of income. It has less industry details, so we have to kind of use the CEW data to give more industry detail to the REA data, but the REA data gets all forms of income. So it could be retirement income, dividend income, other types of capital income, things like that, as I've listed here. So these CA05, CA06, those are just the names of the specific tables in REA for anyone who really wants to know. But those are tables where we get our labor income, our transfer receipts, and capital income from just various tables from that data source. For household expenditures, we get PCE, which personal consumption expenditures, these are at the state level, which is great. And their current, the only problem is that they have all household income groups lumped together. So they just have one spending pattern for all household groups. So to break those out into IMPLAN's 9 household groups, we turn to the Bureau of Labor Statistics Consumer Expenditure Survey, which is lagged a year, but it does have it broken out by income groups. So we just use it to break out our current and state level PCE data into the 9 household income groups. And then there are various other tables from the BEA that we use for other expenditures that households make, like tax and fines and fees and things like that. And included in those data sources are our census and survey of state and local government finances, which gives us money on, or information on what households spend in terms of taxes and fines and fees and other things like that, and transfers and things. Okay, corporate profits. The reason these, oh, and by the way, so savings clearly is a leakage because households are not spending that money. So that's kind of goes without saying, but I'll just say that's why savings are a leakage. Corporate profits are treated as a leakage by assumption because there is too much uncertainty as to where, when, and how corporate profit will be spent. Will it be like will it be distributed as dividends to shareholders? Okay, fine. Well, where do all the shareholders live? And will they spend the money, and on what? Will the company reinvest it in some factory or equipment or something like that? We don't know. Will they repay debt with it? We don't know. So there's just too much uncertainty. It's not a good assumption. But if you did know what a company was going to spend their profit on, you can model that. And we have investment spending patterns and things like that that you can use for that. But as a general rule, we don't re-spend those profits. We keep track of them. They're located in OPI, which is other property income. It is largely and basically corporate profit, but it does also consist of consumption of fixed capital, which is just accounting for depreciation. Okay, so you can see where corporate profits are in IMPLAN. They just don't get respent when you run an analysis. Our data sources for that are all from BEA. They have some GDP data, which gives us gross operating surplus by state and industry. Gross operating surplus is OPI and proprietor income. So we have to split that out into those two components. And we do that by using our proprietor income data, which we also get from the BEA. So then we can use those data to split that GOS into OPI and proprietor income. So that's how we get our profit data. Okay, next circulation leakage is administrative government revenue, which is largely taxes. And the reason this is treated as a leakage is because government spending is not tightly tied to local economic activity. Just because BMW is going to build a new plant in Denver County, for a fake example, doesn't mean that the federal government is now going to spend additional, it is going to receive a little bit of additional tax revenue. It doesn't mean that the federal government is now going to spend more money in Denver County, right? Government has a lengthy budgeting process that is planned far in advance and doesn't really have to do with a new plant being built in a certain place. Typically, government can do deficit spending, which not all of us can, and all of this. So it's safest to treat this as a leakage. Again, if you want to model that in IMPLAN, we have government spending patterns that you can use to model government spending in IMPLAN. So you can absolutely do that. It is not the default. Our data sources are BEA benchmark IO tables. I mentioned those previously. Some of that REA data, again, from the BEA, the GDP data from BEA, the NIPA tables from BEA, and again, that census and survey of state and local government finances. And we have support articles on all of these things if anyone wants to know any more details. One thing I wanted to point out, because it's a common misconception, that taxes come from all components of value added, as well as from households. So value added, which is analogous to GDP for an industry, is comprised of 4 components: employee compensation, proprietor income, other property income, and taxes on production and imports net of subsidies. It is a common thing for people to think that since the word taxes makes up TOPI, taxes on production imports, that all industry taxes are paid out of TOPI. Not correct. You can see here that social insurance taxes come out of employee compensation and out of proprietor income. And then corporate profits tax, of course, comes out of OPI, because as I said, OPI is where profits live. And then all these other types come out of TOPI. So TOPI definitely has the greater variety of taxes coming out of it, but it's not the only place where, only part of industry output where taxes come out of. Okay, and then households pay these various types of taxes there in the last column. Okay, other sources of administrative government revenue. I said most administrative government revenue does come from taxes, but they do also sell some commodities. Think the U.S. Forest Service selling timber, for one example. They also get dividend income, rents and royalties for things like mining rights and things like that. And then business transfers, which are payments to the federal government for certain premiums on deposit insurance, some certain fees and things like that. Okay, and finally for another circulation leakage, we have inventory sales. And the reason this is a leakage is because anything sold out of inventory wasn't produced this year and thus should not generate indirect or induced impacts this year. If something is in inventory, it was produced in some previous year. And so the employees that were paid to produce that thing and the inputs that went into producing that thing were all purchased and paid for in that previous year. So those impacts already happened. So they shouldn't, it would be double counting them if we counted them as new impacts happening this year. And our data source for this is the annual survey of manufacturers. I know that looks like a typo. It's not manufacturers, it's actually manufacturers. It's a weird thing. I wasn't familiar with that word before, but that is the name of that survey. And that's where we get our inventory sales data. Okay, the last thing we wanted to point out was just that all of these data can be found in the IMPLAN SAM. And I'm going to hop into the IMPLAN SAM and into IMPLAN, into the IMPLAN app, and I'm going to just show you, for those who aren't familiar, how to export the detailed SAM, because the SAM has the detailed SAM. Oh, I'm sorry. SAM is social accounting matrix. It's basically the picture of all the interactions that happened in the economy in that year, and we call that the SAM. And the detailed SAM is too big to display online in the app, but you can export it from the application, and I'm going to show you how to do that and pivot it into a matrix. And then we'll just look at a couple of these types of leakage and transactions that we've talked about today. Okay, so I'm going to now bring over my screen. Wes, can you confirm that you're seeing IMPLAN? Or anybody?
Yes, I am.
Sure are.
Sorry about that.
We gotcha.
Okay. All right, thanks. Always want to make sure. Okay, so here I am in IMPLAN. I'm going to click on the regions tab or button, if you will, and I'm going to pick Colorado just since that's where I happen to be. And then I'll click View Region Details. Within here, there are all these tabs, one of which is called Social Accounts. And remember, I said the SAM is the Social Accounts Matrix or Social Accounting Matrix. And here you can see a less detailed SAM. You can see that in IMPLAN. And so you can see a lot of the transactions that happen. But if we want to get into really nitty-gritty detail on so you could see what households are paying here to federal government, for example, but it wouldn't tell you what types of payments. Well, how many of those are taxes? How many of those are fees or fines or something else? And so for that, we want to go into the detail SAM. So I'll click on that social accounts tab again and hover here over export detail I/C SAM. And sometimes it takes a little bit, but sometimes it's really fast. So I'm going to go ahead, click save. And it was really fast today, so that's great. And it popped up in this other window. Okay, sorry, Excel was asking me a question. All right, so here is what it looks like when you export it. Now, all it has done is put all the data here. This is all the data that is in the detail SAM. This is the thing that drives IMPLAN impacts. These are all the transactions that happened in Colorado in 2022, which is the year of this data. You can look at it like this and use it like this. This is no problem. But I like it makes more sense to me visually to look at it like a matrix. So I'm going to go into Insert Pivot Table. I'm going to accept the default here. And what you do is you put the paying code into the column. The payer is usually the column, kind of the default setup. And then the receiving code is the row. Okay. And then you put value into the value bucket. Makes sense. And then what I want to do, if you want to see what types of transfers are happening, what I usually do will take the transfer description and bring that over into the row as well. The more of these things, if you also do the paying description, the receiving description, the transfer code, all those things, then your Excel file just starts to get a little unwieldy and less responsive. So it'll work, but it's less nice. And then usually I'll, freeze panes here so I can scroll around and see values and whatnot. What I'm going to do, since I already had some highlighted nicely, I'm going to bring over one that I've already made. So this is the same thing. This is the 2002 Colorado detailed SAM, but I've just added some nice labels here at the top and some highlighting just to make things easier to look at. And one thing I do want to point out first is that you see that we have all these codes, 8,001, 10,001, 5,001. I'm telling you that 5,001 is employee compensation, 6,001 is proprietor income, but how did I know that? I know it because I have them memorized and I've worked at IMPLAN for 14 years, but how are you gonna know it? So what I wanted to point out first is that we've got this nice support article called Constructing the IMPLAN SAM, and in here you can see all of those codes. So we have all those institution codes where you can see that 5001 is referring to employee compensation. So if you're digging deep into the detailed SAM, this might be a useful article for you. It also has our transfer codes. So here are all those various types of taxes we were talking about. Look at TOPI, it's got sales tax, property tax, severance tax, all these things. We've got personal taxes, and they all have codes in the SAM. And those are just for us to be able to keep track of them. So if you want to, if you're looking at the detailed SAM and you don't want to bring in all those descriptions because it makes Excel kind of unwieldy, you can just have these tables handy with you, and then you'll know what each of those codes is referring to. Okay, so I added some labels and some coloring here. Let me scroll down and show you that I've highlighted some things in yellow, which are savings. So here, because I have those transaction descriptions, I put that as part of my pivot table. It brought up that description for me, which is great. So, and here what I've highlighted are the household columns, their borrowing and saving. And as we had mentioned, you can see that the lower 7 household income groups didn't have any net savings in 2002 in Colorado, but the 2 highest income groups, household income groups in Colorado did. Now remember, this is net saving. So it didn't mean that none of these households had any savings. It just was on aggregate for that household income group, more of them saved, or excuse me, more of them dissaved than those that saved in dollar amount. But here's where you can see our leakage of savings. Okay, another would be commuting. We said commuting was a leakage. So this would be factor trade. And that comes out, if I'm not mistaken, of EC. So employee compensation, some of it flows to commuters. We also said some of it flows to government as taxes. So there's the payroll taxes, those stay local. Remember, it doesn't matter where the worker lives. If they work in Colorado, they pay payroll taxes in Colorado, and there they are. So employee compensation, some of it goes to payroll taxes, some of it goes to commuters. That's this factor trade. And then if I scroll up, you'll see that a bunch of it is going to households. It's paying wages to households. So here I've got my various household income groups, and they're all getting paid out of employee compensation. So this is after tax income, or after payroll tax income, to people who work in Colorado and live in Colorado. Okay, another one would be imports. So I've got that highlighted green. It's our commodity trade row here. Just pointing out that you can see that households import some stuff. If I scroll, government imports some stuff. If I keep scrolling over, if I scrolled left, we'd see industries importing stuff. Let's see, here's industries. We're in the industry columns here. Industry 75 is importing that many $1 million of commodities, okay? And then I guess that's basically, here I'm scrolling back right so I get back to our kind of GDP numbers. Here's OPI, where profits are, paying rents and royalties to state and local government. And that's just because I know 12,001 is state and local government. Again, you guys can refer to that article to see what each of those codes means. But this is just this is a lot of data in here. It can be kind of overwhelming. Not everyone's going to even want to go in here at all, and I don't blame you if you don't want to. But it's just to highlight that all of these data behind all of these spending that happens locally and what's leaked or not leaked is there in your model, and you can see it. And all the impacts that you see are based on all these interactions here in the SAM, unless you have done some customizing, in which case your impact results are going to look a little different than what the SAM generated impacts would be if you've done some customizing. But otherwise, it's all based on what's in here and ratios from this SAM on how much household income is saved and things like that. Okay, that concludes our presentation. I don't know if we want to get to some questions. Candy or Wes? I don't know who's manning what.
I think so. Yeah, we've got a couple of questions,
We've got those questions.
In the chat.
Would
yes,
anyone,
indeed. So are you able to hear me okay, Jenny and Candy?
Yes, I can hear you.
You sound great, Wes.
Okay, great. Sorry, I just wasn't sure if I was coming through, but I will go ahead and start with one of our questions that we got from Paul Coombs. So we got a question: how is it valid to treat Chipotle spending as new to the various regional economies? Isn't it likely that they are simply displacing spending at other less successful restaurants, as well as spending at grocery stores? It does not seem valid to apply multipliers here. Okay, so thank you for this question. It's a really good one. And the answer is that yes, you're correct. There is likely a displacement effect going on here, and that all of the spending on Chipotle is not going to be a total net new. The example is chosen more just to be a high level overview of the type of study one might run an IMPLAN. That way we could illustrate kind of what multiple iterative rounds of spending will look like. But I would definitely still say that it is valid to use multipliers or the IMPLAN software to take a look at this still. So what we would advise would be to take into account the displacement effect that you mentioned itself. And you can do that through using a net analysis. So for example, if we kind of ran with the example that Chipotle was making $800,000 per location per quarter. Let's say we were looking at a single location going into a regional economy, and we were able to determine that $500,000 of spending is assumed to be removed from grocery stores, and let's say $300,000 is assumed to be removed from full service restaurants in order to make up that $800,000 of spending on Chipotle. The best case scenario would be to input a negative $500,000 into your grocery store sector, a negative $300,000 into the full service restaurants sector, and a positive $800,000 into the limited service restaurant industry, which represents Chipotle. So remember that different industries have different spending patterns, and each commodity has its own levels of supply and demand in the area. Just like we were mentioning earlier, how much of a specific commodity is imported or used up locally, that all changes based on the commodity in the region. And thus, these net analyses can yield impacts because of those types of differences. So even though, at first glance you might assume, oh no, there's not really an impact, that's a zero, there definitely can be. Those impacts can be positive or negative. It is definitely a valid use of IMPLAN to determine whether the arrival of a new business can be kind of good or bad for an economy based on the existing structure of your region, those existing economic linkages that are present. So that is kind of how we would generally guide towards that. Of course, if you had a more specific study, or we were using something that was a little more detailed than just this example, our education services team and your customer success managers are always happy to walk you through what considerations are best to take into account and how to set up those kinds of studies.
Thank you, Wes. That was a fantastic answer, very thorough. I see a question about whether leakages are only accounted for at the state level and above. Someone has created scenarios at the county level and they never show leakages. So yes, leakages are accounted for at every level in IMPLAN, so all the way down to the zip code. Zip code models will actually should have more leakages. The smaller the geography in general, the fewer workers that are going to live there, and the fewer goods and services are going to be produced there. So the smaller level should have larger leakages. Not all leakages are displayed in the IMPLAN results. Like there's not always a box that says here was household savings that were set aside. You kind of have to look in that detailed SAM and see how much savings were taken out. Some types of things are displayed in the impact. For example, your tax impact report. I mean, those are leakages right there in that sense that they're not respent. So I would suggest reaching out to your customer success manager if you're having trouble finding those or feeling confident that those are being treated correctly in your model or analysis, and they'll help you find those.
Excellent. So can you briefly explain how the trade merchandise data was controlled to annual? So absolutely. So we get an annual value for foreign imports from the NIPA tables. And basically all we're doing is making the sum components for all of our different commodities sum up to that value. So for instance, were the sum total, and I'm just going to use some made up numbers, for the sum total 100, and we had foreign import values of, let's just say, 3, 3, and 3, summing up to 9. Essentially what we would do when we control those values up, we need 3, 3, and 3 to add up to 100. So those values would essentially just become 33 and a third, 33 and a third, and 33 and a third. Just basically kind of bringing those values up, boosting them up to make sure that they add up to the desired total while still keeping the proportion of them to each other relative.
Thanks, Wes. There was another question on the survey on those data and on the merchandise trade data and what level of geography they are at. And we use national level values for that. So we distribute those trade values out to counties, states and counties.
Excellent. So will we receive this amazing presentation after the webinar is over? Yes, absolutely. We will send out an email that will give you access to the webinar section on our support site, which is support@implan.com. And then relatedly, I saw one that asked if we are planning on displaying leakages based on whether they, what type they are. At the moment, yeah, does IMPLAN have a plan to present those leakages by geographic and circulation? So at the moment, no, but we are always here at IMPLAN interested in what is going to be most useful to you as an IMPLAN user. So if that is something you would like to see, we're very happy to take that feedback. We'll record it from now in this meeting, but as with this kind of a request, or really any kind of feature request that you'd like to see, we would just encourage that you reach out to your customer success manager. If you don't know who that is, you can also reach out to support@implan.com. We do keep a running tally of kind of any of those feature requests that you have. So certainly happy to consider it.
Wes, I think we have time for at least one more, and I have one that's is wondering if we account for spending from credit, which can exceed household income. And so, yes, you'll also see in the SAM, I didn't point this one out, but for those households who aren't putting things into the capital account, you'll see that typically, if we had scrolled over to the capital column, that column is making a payment to households, meaning households were receiving money or dissaving. is what that is, or borrowing. So it's either drawing down existing savings or borrowing, somehow getting money out of the capital account. And really all the household spending that happens in IMPLAN is based on what's in that SAM. So if you look at that household column, however much of each dollar that they receive that goes to the various commodities and that goes to various taxes and that may or may not go to savings, that spending pattern is what drives those induced impacts. So they're going to be based exactly on that. I hope that answered the question. If not, we can certainly follow up with some more information over email.
Yep, and relatedly, actually, just to kind of piggyback off of that answer, we got the question, communities are always interested in consumer trade leakage. So can you use IMPLAN to understand consumer expenditure leakage by type of good and service? And yes, the answer is yes, you absolutely can take a look at how much households are buying versus from within a region versus without coming from outside of a region. And as a matter of fact, it's both available in the SAM, and then if you were to look at your household spending patterns, that's an event type in IMPLAN, so under the impact page, and expand your household spending patterns, you are able to see what we call regional purchasing coefficient. It's labeled RPC, and you can kind of see, how much is going to be coming from inside versus outside. There are many tools within IMPLAN to get at this type of question. So once again, if you do have that kind of question, if you're interested in getting a little more invested into more granular details of data, your customer success manager should be able to help you out with that, or support@implan.com can help you out with that as well.
Thanks, Wes. I think we have, I'm not sure if this question was answered, just 2 more questions, but how granular is Census Bureau merchandise import data? Did you all cover that?
We did. I said that we use the national level data. The user, I think who wrote that question, said they thought they existed at the state level data, which is certainly something we'll look into, but our understanding was that it was national level only. So we use the national level and distribute those values out to states and counties. They do have some port level data, imports and exports going in and out of specific ports. And previous IMPLAN colleague of mine, Jimmy Squibb, and I did some analysis on that and wrote a paper and presented a paper and kind of did some exploration of whether various states should have different import rates of certain goods depending on how close, whether that state had a port or not, or how close they are to a port. And, our results were a little, I'll say we didn't get a lot of feedback about users thinking that was a good idea. And it comes with some questionable assumptions like, yeah, perhaps people in California and Florida might purchase more imported fruit because they have ports and more access to that. But for goods that aren't perishable, it seemed unlikely that folks on the coast or on river ports would consume a higher rate of imported electronics, for example, and cars and things like that than in states that don't have a port. So I'll just say that we'd love more feedback if you want to talk to us more about this, and we can certainly look and make sure we're using the most granular data we can. But our understanding is that it's at the national level, and when we've tried some other techniques to go use state-specific trade rates, it didn't pan out so well.
Thanks, Jenny. And one last question I'm going to try and squeeze in. Is there a time component to leakage? In other words, do the multipliers account for respending that occurs at any time downstream from the direct, or only that which occurs with a specific time period?
Oh, I thought you were going to answer it, Candy.
Jenny or Wes, you want to take that? Oh, I'll take it. Absolutely. Yes, everything in IMPLAN is an annual model. So it's only going to account for things that are happening within that year, yes, unless spending was specifically analyzed across a different year. So thank you, everyone. I think we got to all the questions. If we didn't, please let us know. Email support@implan.com. Special thank you to our Chief Economist and Data Officer, Jenny Thorvaldson, and her fantastic team, Wes Morgan, for putting together this presentation. You'll receive an email afterwards linking to it if you would like to revisit anything, and we will see you next month. Thank you.
Ken. Thanks, Wes. Thanks, everyone. Bye now.
Thanks all. Goodbye.